Welcome to Takeaways. My name is Jordan Brooks, Director of Market Analytics with ALN Apartment Data, and this month's newsletter was titled Price Class Divide Widens Across Multifamily Performance. As it sounds like, the newsletter this month was basically a deep dive on performance across classifications. There's been an increasing divergence in price class performance between the top of the market and the workforce housing segments, particularly on the rent front. But one area that we didn't touch on in the newsletter was some market-specific information. We kept it more broad at the national level. So I wanted to just bring to your attention some market level highlights, particularly in the workforce housing segments. And so starting first with Class C, market leaders nationally in net absorption were markets like Phoenix, Austin, Dallas-Fort Worth, Denver, and Orlando over the last year. All of those markets were in the top 10 nationally, but operators were really trading that absorption and occupancy gains for rent growth. So if you look at average effective rent performance in those markets for Class C, each of them were down between 3 and 6% over the last 12 months. And a big part of that was lease concessions. Lease concessions, over the last few years in particular have been more story at the top of the market. With the surge of new supply coming in, we saw lease concessions expand in the Class A and Class B segments. More recently, we've seen pretty significant expansion in both discount availability and value in the workforce housing segments to sort of prop up the absorption in that part of the market. So concession availability in those markets that I mentioned, specifically for Class C, ranges from about 40% to 55%. And again, that's as of the end of April, with the average discount value rising to nearly 6 weeks off of an annual lease in Austin. So Austin in particular, again, a leader nationally in Class C absorption, but it's really come alongside significant expansion in both concession availability and value. 6 weeks off of a 12-month lease for a Class C is unusually high, to say the least. And then in Class D, there's actually been an even more significant shift in rent performance, again, alongside absorption that for the most part still looks pretty healthy, although there are some exceptions at the market level. But in terms of net absorption leaders for Class D, you're talking again mostly about the same markets: Phoenix, Tampa, Orlando, Dallas-Fort Worth, Austin. These markets again are all in the top 10 nationally for Class D absorption over the last year. But average effective rent in those areas is down anywhere from 6% in Austin, in Phoenix and Orlando rather, all the way to down 13% in Austin. Concession availability in these areas is ranging right now anywhere from 48% to 76%. And again, that 76% mark is in Austin. And the average value there of the lease concessions that are available in Class D is nearly 7 weeks off of an annual lease. So again, we've seen really significant expansion in lease concessions, pretty dramatic drawdowns in average effective rent in these markets that, again, if you're just looking at recent absorption and occupancy gains, have looked pretty good. And so again, this is a reminder that the new supply pressure of the last few years is not just a factor at the top of the market. There is sort of a cascading effect over time down into the workforce housing segments as well. And then also, again, just sort of an affordability issue where demand is being maintained, but there's not enough to maintain positive rent growth alongside that demand. So we're now in the strongest part of the year for leasing activity. The next couple of months are going to go a long way to determining how 2026 ultimately shapes up in terms of, again, both absorption performance, but also rent performance. Ideally, in the next couple of months, we would see lease concession availability start to come down a little bit in these markets before ultimately, just from a seasonal perspective, we would expect an increase again in the fourth quarters. The next couple of months will provide some clarity on whether these markets will be able to kind of regain some footing, or whether it's going to be a little bit of a tough year in 2026 and 2027 is maybe a better opportunity for a full recovery in terms of occupancy and rent performance. But with that, I just wanted to leave you with a couple of upcoming events that may be relevant to you. I'll be doing a market update webinar for the Apartment Association of Greater Los Angeles on June, and also a market update webinar for the Arizona Multi-Housing Association on June 11th. So if those markets are relevant to you, be sure to check our social media for registration details. Look for ALN Apartment Data on your social media platform of choice, and you'll find us there. We also have additional content going up on our blog, alndata.com/blog. With that, I'll see you next month. Thank you.